The Federal Reserve just made a move that could change the tone of the entire housing market. On Wednesday, the Fed cut interest rates by 1/4 percentage point and signaled that as much as 3 more quarter-point cuts could still be on the table for the rest of the year. In total, that could mean 75 basis points in easing before we close out 2025. For a company like LoanDepot, ticker symbol LDI, this is a big deal. Mortgage lenders and servicers live and die by the level of rates. Lower borrowing costs mean more refinancing activity, more originations, and a healthier servicing portfolio. And it's no coincidence that LDI's stock price ticked higher on the news, finishing Wednesday up 12 cents, or about 2.8%, to close the session at $4.56. That may not sound huge in absolute terms, but for a company like LDI that trades in the small cap range and often moves on sentiment, it's a meaningful reaction. But was this just a knee-jerk bounce to a Fed headline? Or is it the beginning of a bigger story, one where LoanDepot, after years of headwinds, starts to benefit from a friendlier macro environment? Let's dig into the details and see what's really driving the narrative. The first thing to understand is why rate cuts matter so much to mortgage lenders. When rates are high, homeowners are reluctant to refinance. Monthly payments are higher, affordability is stretched, and transaction volumes drop. That's exactly what we've seen over the past couple of years. The mortgage industry has been in a funk because borrowing costs shot up as the Fed tried to tame inflation. But when the Fed pivots to easing, as it did this week, the dynamic changes. Suddenly, refinancing becomes attractive again. Buyers who are sitting on the sidelines might be tempted back into the market. And for companies like LoanDepot, that means more originations, more servicing revenue, and more life in a business that has been squeezed. Now, let's put this in context for LDI specifically. Earlier this year, LoanDepot was thrust into the spotlight when Citron Research, yes, the same Citron once famous for shorting companies like Valeant and Tesla, released a bullish report on the stock. Citron argued that LDI's servicing portfolio alone was undervalued by the market, pegging it at about $5.50 a share, which was well above where the stock had been trading. For retail traders on Reddit and FinTwit, that call was enough to get the ticker trending. Since then, LDI has been on and off the radar, but Wednesday's Fed move brought it back into focus. Remember, Citron's thesis hinged on the value of the servicing book, and servicing income is directly linked to the health of mortgage payments and refinancing opportunities. Lower rates, in theory, could make that portfolio even more valuable. So the timing of the Fed's cut adds fuel to Citron's case. Now let's talk about LDI's financials. In its most recent quarterly results, the company reported narrowing losses. Revenue was higher, margins improved, and the net loss shrank compared to previous quarters. The balance sheet showed about $409 million in cash, which provides some stability, and founder Anthony Hsieh has returned as permanent CEO, bringing a sense of continuity and leadership that the market likes. These are not the numbers of a company firing on all cylinders yet, but they are the numbers of a company stabilizing. That's important because it means LDI has some breathing room to take advantage of a changing interest rate environment. If the Fed continues cutting, that could be the tailwind LoanDepot needs to push closer to profitability. Now, how does this compare to another name in the housing space, Opendoor Technologies, ticker OPEN? The two companies operate in different corners of the market. LDI is about mortgages and servicing, while Opendoor is about buying and selling homes through its iBuyer model. But both are sensitive to rates, and both have been darlings of retail chatter in 2025. Opendoor has had its advocates, most notably Eric Jackson, who has been vocal on CNBC and in open letters to management. His bullishness helped keep retail attention on the stock. For LoanDepot, the role of the advocate has been Citron Research. The messengers are different, but the result is the same. Retail investors suddenly care about housing stocks again. And that raises the big question: are housing plays becoming the next retail sector trade? Think back to the cycles we've seen. In 2020, it was meme stocks like GameStop and AMC. In 2021 and 2022, EVs and clean energy names dominated. Last year and into this year, it's been AI, with Nvidia and Palantir leading the way. More recently, Bitcoin miners and crypto stocks surged alongside digital assets. Retail is always searching for the next theme, the next underdog story that could produce outsized gains. Housing makes sense as that next chapter. It's relatable, everyone understands mortgages, affordability, and home ownership. It's contrarian, most people have written off housing companies because of the tough macro backdrop. And it has a built-in emotional hook, because everyone has a stake in the housing market in one way or another. But optimism has to be measured. For LoanDepot, the risks are still significant. The company is not profitable, and it's extremely sensitive to interest rates. Just because the Fed cut doesn't mean mortgage rates will instantly plummet. The mortgage market often lags Fed moves, and long-term Treasury yields also play a role. If those yields stay sticky, the benefit to LDI may not be as large as bulls hope. There's also execution risk. LoanDepot has been restructuring, cutting costs, and trying to run leaner. Those efforts have improved the financial picture somewhat, but the path back to consistent profitability is not guaranteed. For Opendoor, the risks are different but just as real. The iBuyer model depends on managing housing inventory profitably. If the company buys too aggressively into a falling market, or if home prices don't behave as expected, losses can mount quickly. And while rate cuts may stimulate activity, they don't automatically guarantee profitability for an iBuyer. Still, what makes both names compelling is the asymmetry of the trade. Investors know the downside: LDI could keep losing money, Opendoor could mismanage its inventory. But the upside, if the macro environment shifts in their favor, is much larger. And that's exactly what draws retail investors to these kinds of stocks. So, what does Wednesday's move mean for LDI going forward? In the near term, it validates the bullish thesis that conditions are getting better. If the Fed really follows through on 75 basis points of cuts this year, mortgage activity is likely to pick up, and that could translate into real revenue growth for LoanDepot. Combine that with the undervalued servicing portfolio highlighted by Citron, and you can see why retail traders are getting excited again. In the medium term, though, execution matters. Investors will want to see whether LoanDepot can actually turn those macro tailwinds into bottom-line improvement. That means paying close attention to quarterly origination volume, servicing income, and expense management. The broader housing market also plays a role. Affordability is still stretched, inventory is still tight, and consumer confidence will determine how much demand materializes even if rates fall. LDI is tied to these bigger forces, which means macro data will be just as important as company-specific news in driving the stock. For investors, the key takeaway is this: LDI has catalysts now. A Fed that's cutting rates, an undervalued servicing portfolio, improving financials, and a CEO back at the helm. It has risks, yes, but it also has a clearer path to upside than it did even 6 months ago. That's why Reddit chatter is heating up, that's why the stock ticked higher on Wednesday, and that's why housing stocks as a group are worth watching closely. And here's the big picture question: is this just a one-day pop tied to the Fed? Or are we seeing the start of a retail-driven narrative where housing becomes the next meme-worthy sector? If it's the latter, then LoanDepot may be positioned as one of the leaders of that move. So as we look ahead, keep an eye on 3 things. First, the Fed's next steps. Will they follow through on additional cuts? Second, mortgage rate trends. Are they falling in line with Fed policy, or staying sticky? And third, LoanDepot's execution. Can the company turn this more favorable macro backdrop into sustainable progress? If those 3 elements line up, LDI could go from being a forgotten mortgage lender to a stock at the center of the next retail trade. That's the kind of setup that gets traders excited, and that's why Wednesday's news matters more than just a 12-cent bump in the share price. In the end, it's not about whether LDI is perfect. It's about whether it has the potential to benefit disproportionately from a changing environment. Right now, with the Fed finally cutting rates and signaling more to come, that potential is greater than it's been in years. And that's why LoanDepot deserves a closer look.